And leave it to contrarian badass Reggie Middleton. He called the housing crash. He called the collapse of Bear Stearns and Lehman Brothers. He's been harping on the crisis in the Eurozone banking system for years now. So he's just the guy to talk to.
Reggie Middleton.
Reggie Middleton.
Oh, he doesn't mince his words. We're talking about Reggie Middleton.
Ooh, it's Reggie Middleton.
Greetings, everybody. This is Reggie Middleton. September 30th, 2016. I'd like to continue our commentary on Deutsche Bank. For those who don't follow me, I'm a fire expert, finance, insurance, real estate, and I also do distributed technology, blockchain technology, internet, mobile technology, phones, etc. I'm known for calling Bear Stearns and Lehman Brothers and Countrywide and Washington Mutual and General Growth Properties, a lot of those collapses, AMBAC, and BIA. So I'm pretty good at this finance company, bank, balance sheet malaise. Starting last year, roughly about October 2015, I made it clear that Deutsche Bank was on its way down. Okay, 55, 60 points later, this is where we are. Bloomberg ran a story this morning saying that John Crine is trying to vindicate his bank, and basically the game of trust that is the fractional reserve bank system is being undermined by malignant, notorious players. I'm paraphrasing, that's not exactly what was said, but that's the gist. Well, Mr. Crine, if you are somehow inferring entities such as Veritasium or pundits such as myself or those who are trying to undermine trust, in no way whatsoever. What I am doing is I'm trying to relay the truth. Yes, trust is what underlies the fractional reserve bank system, okay? Deutsche Bank has a problem. That problem was evident over a year ago, okay? Deutsche Bank has a serious problem. Now, in that Bloomberg article, we have the run that I predicted has already commenced. Several of their counterparties are pulling back exposure, primarily funds who are clearing through Deutsche Bank since they're not clearing members themselves. That means that they're having their trades go through Deutsche Bank, you know, for those who are not part of that, you know, nerdy lingo. Well, a lot of analysts have come, including the Goldman analysts, have come to Deutsche Bank's back and aid, saying that the problems are overblown. I wholeheartedly disagree. Number one, the mere perception of risk at Deutsche Bank creates risk at Deutsche Bank. Like Mr. Crine said, it's a trust game. If you don't trust Deutsche Bank, then trust is not there. You know, it's a dual argument, it's a two-faced argument, but it's a fact. Okay, that's number one. Number two, look at the numbers. Okay, Deutsche Bank pays roughly 0.05% in terms of interest rates on its savings account. It can literally be withdrawn or request to be withdrawn like that. The risk you take in putting your money in Deutsche Bank is significant. Deutsche Bank has a junk rating as a standalone baseline credit line. It has 1 or 2 levels above speculative ratings in almost every other line, okay, by Moody's, and they have negative or stable outlooks. Almost all negative outlooks. You know, that is rather risky, much too risky to only get 5 basis points or so back on your money. Much too risky. So if you're going to invest in a high-risk company or a junk company or a high-yield company, why would you accept extremely low yield? Now, again, Mr. Crine is et al. And the other analysts who are also analysts who work for fellow member banks, and we'll get to that in a second, so remember that point, are saying it's a trust issue. Far from a trust issue. Do not blame the messenger. Do not shoot the messenger, okay? Deutsche Bank's woes, number one, came from excesses during the last credit bubble, okay? Number two, it came from the fix for these excesses, from the ECB. Don't blame me, Mr. Crine. You blame the ECB, okay? The ECB, they followed NERC policy. They pushed rates close to zero, to zero, then past zero and negative. That created a perverse incentive and an environment that is basically the antithesis of capitalism and free economic markets. And there you have it, Okay, so here we have a high risk, high yield investment, Deutsche Bank, in terms of savings accounts, giving a low yield. What the hell do you expect people to do? Okay, anybody who is remotely well versed in third grade arithmetic, or knows anybody who may be remotely well versed in third grade arithmetic, would say, 5, 6, 7, 8% risk in exchange for a 0.05% return. I'm out of here. And you should be. Okay? Very, very simple. Now, the hedge funds are starting to scale back. And again, there's only a small modicum of hedge funds coming back. I think they have roughly 800 clearing clients. Maybe three or five have left thus far. That's a very good idea. Diversification of risk. There is no reason to concentrate your risk with Deutsche Bank with share prices dropped 55 to 60% over the past year, which I did call, which has a $14 billion fine requested for the Department of Justice. May I add, the average settlement between the American U.S. banks has been about $8.1 billion. If you go to the site, I will post a list of much more litigation over just last year and a half to 2 years, amounting to what looks like, including the Department of Justice, if I had to give a ballpark figure, $6 to $9 billion, worth of litigation from a settled perspective. Deutsche Bank has reserved $4.6 to $4.7 billion for litigation. And there's more coming up if you look at Deustche Gold articles, which is a Deutsche Bank subsidiary. So, long story short, don't blame me, don't shoot the messenger. You go over there and aim your guns at the guys at the ECB with their NERP policy. Now, it's not like the ECB are bad guys, because the reason why they pursued NERP, misguidedly, but still pursued NERP, was to save the balance sheets of these banks, because these banks have rotting assets, and these rotting assets will start smelling and decaying. But through the negative interest rate policy, they buoyed these assets. But when you buoyed the assets, you choked off the income statement part of the business. So it's like having a person drowning, you're running out to save them, the ECB grabs this person by the neck, lifts them out of the water. So you prevented them from drowning, now you're just choking them out. Damn if you do, damn if you don't. So there is a way out of it, and I explained it before. You let the insolvent entities fail. Without that, you simply stagnate the economy, until those entities fail. So you're going to have basically the end result come one way or the other. It either happens quickly or slowly. If it happens slowly, there is a slight chance that they may not fail, but that failure is still in the system. It's just crept into the taxpayer base, and now everybody suffers. Let those who took the risk, right, they were able to privatize their profits, allow them to privatize their losses as well. Okay, now, if you take a look at Deutsche Bank's 0.05% return for the savings account, Q in here, you can compare that to a real risk, or a risk that is truly compensated, like the PIMCO short duration high yield bond fund. Basically, short-term bonds, a high risk, I think it's paid about a 4.6% yield year to date. Okay, that's pretty good. That is 9,300% more than Deutsche Bank is paying you for roughly a better risk. Now, many would say, what do you mean a better risk? It's a high yield ETF. Yes, it is. But there's a very, very slim chance, close to no chance, of you getting a bail-in. The disclaimer for the Deutsche Bank savings account should clearly say you're at risk of losing your investment or having it forcibly turned into bank equity. If that were to happen, that means the bank equity would have fallen close to zero anyway, as we're seeing Deutsche Bank happen. So basically, you get it turned into little IOUs worth nothing, or little equity notes worth nothing. With the ETF, that type of absolute loss is not possible as I see it. Possible, highly improbable. It hasn't happened yet that I know of. Has it happened in the banking system? Let us count the ways. You had those Iceland banks. You had the first bail-in example. You had MF Global. You had Lehman Brothers. You had Bear Stearns. Yes, it can happen. So take a look at the disclaimer on the PIMCO funds. Take a look at the yield. Take a look at the risk. Take a look at the disclaimer on Deutsche Bank savings accounts. Take a look at the yield. Take a look at the risk. Once you compare, of course everybody's going to leave Deutsche Bank. Even if you don't want to go into a similar risky asset, you can at least go into a lower risk asset. So either lower risk, right, minimum return, or if you insist on taking a higher risk, get paid for it. Simple third grade math. It's amazing and it's interesting that the disclaimer is saying on the ETF saying that these are not banks, these are not deposit bank accounts, is more positive than the disclaimer on the actual bank accounts. Since when is the disclaimer that this is not a bank account supposed to be a good thing relative to banks? It's a new day, my friends. Peace. Au revoir. Zaijian. Ciao. Adios. Bye.